Welcome. What you're about to watch is a recording from a live call that we did last week. These calls are not intended as financial advice, and they are simply meant to be educational only. Your situation is unique to you, and we want to be able to provide education for the consumer to understand what different options they have available. So this video is not intended as individual financial advice. If you have questions, make sure you leave them in the comments below, and we'll make sure we can do our best to get to those and answer those. And as always, if you have specific questions that are unique to you that you want answered for your position, for where you are, you can always schedule a call with myself or someone from the team just by using the links in the comments below. So enjoy the video. It's absolutely free. And check out the description if you want to register for next week's live Wealth Wednesday. Enjoy. All right, everybody, 4:03. I'm going to get going. I got a couple of things lined up to chat about, but in the chat box, let's go. Three main topics I want to discuss: controlling our wealth, and so we can create cash flowing assets before retirement, tax avoidance in retirement years, or number three, some other topic that you would want to discuss. So let's make sure we hit one of those three. So it's either controlling our wealth to generate by cash flowing assets before retirement, avoiding income tax in retirement, or something else I haven't thought of. Go ahead and leave it in the chat box. Let me know what you're thinking. The chat box is the best way to communicate, unfortunately. If somebody does want to say something, just raise your hand in the chat box. You just put a little, if you click that emoji guy, and do, how do you raise your hand? There we go. Let's do one of those. David, we can certainly cover the first two: how to control our wealth, cash flowing assets, and avoid future income taxes. In the chat box, if you think future taxes are going to be higher in the future, write up. If you think taxes will be lower in the future, write down. John, I agree. Up. Capital letters. Up. Great. Taxes will probably be higher. Okay. So avoiding future income taxes should be on the priority list, because remember, if you listen to last week's, there's a difference between gross and net numbers, and the financial industry teaches you how to focus on gross numbers, not net numbers. And what the consumer cares about is the net number. The gross number is fun to talk about, but how much am I going to keep of all of this? And a lot of people have assets where they don't understand the net number. And remember this is a big one. We're dropping bombs early. When the government says we want to tax the rich, they don't. I don't, if you can hear me not correct, they don't, and they won't. My opinion, and which is what I teach, is rich people know how to create value in the world, and it helps the economy, it helps America grow. So they want to incentivize that. What the government will do, however, is tax your ability to get rich. And in my opinion, most of the strategies that the financial planning industry teaches is how to invest in assets that will trigger ordinary income tax, the highest tax in the tax bracket. Warren Buffett's quoted as saying, "My secretary pays a larger effective tax rate than I do, because she earns income, he's selling assets. She pays an income tax, he pays a capital gains tax when he sells." Or he does that four-letter word that everybody hates. It's my second favorite four-letter word. Warren will borrow against assets as debt and pay zero tax on that bad boy. So we want to understand the rules of the game. How can I maximize my net number, avoid future income taxes, control my wealth today? And I think we'll have a good 30-minute conversation. How's that sound, everybody? I feel like y'all are into that. I'm going to share my screen. Well, you tell me in the chat box how excited you are about this conversation. I hate talking to myself. I'm going to make dumb jokes and laugh. And hopefully you're laughing on the other end. I can't see you, which I'm talking to my team about changing the format of this whole thing because I don't like not being able to see everyone. For example, no one made a comment on that, that wonderful joke. Okay. I like to start with broad strokes, big picture. So big picture, that yeah, I have a circle drawn here. If this circle represented all of the wealth that you have and that you can create, if that circle represents all of the wealth that you have, that can eventually generate cash flow for you. I'm going to draw a line here. How much do you want off the radar screen of the IRS for income tax purposes? Where should I draw that second line? You can tell me, imagine a clock, 9 o'clock, 12 o'clock, 3 o'clock, 6 o'clock, where, 7:30. Where, how much of your assets do you want off the radar screen of the IRS for income tax purposes? David, you're conservative, 75 to 100. I like it. You know why? Because David wants to make sure he pays his fair share. And I want everyone on the call to understand you have to pay your fair share. Otherwise, you go to jail. So definitely don't want to teach tax evasion. I just wanted to learn how to legally avoid future income tax. So what's interesting about the income tax is taxes due on income that's earned. And if I don't earn income, I pay no tax. And this is the fallacy of the 401k and an IRA, a SEP IRA. If anybody has these in the comments, type in 401k if you have a 401, type in SEP IRA. Curious to see if any business owners on the call have a SEP IRA. Unfortunately, you know, the CPA will tell us that you're going to save money in taxes by funding a SEP IRA or a 401k. At a 403, Doug, public servant. And the truth is there's no tax savings. It's just a tax postponement. The client never actually took receipt of the money. If you put money in a 401k, you never saw the money. You never pulled out the Benjamins and hey, David, I was hoping you were going to say that. You never pulled out the Benjamins and looked at them. That's why you never paid tax on the money. It went from your employer directly to a SEP. And the CPA lies to you and says you're going to save money on taxation. It's not a tax savings, it's a tax postponement to a time we've already agreed taxes will be higher in the future. Well, what do you want the account to do? You want the account to grow or get smaller? Grow. Think about how silly this is. We are convinced to put money into an account that we want to get higher, that's going to be exposed to future taxation, where we think it'll be higher. My house will be paid off. I don't have a mortgage deduction. My kids are moved out. I don't have the kids' tax credit anymore. I sold my business, so I don't even have the business deductions. I'm not funding the 401 or the SEP IRA, so I don't have that, you know, deduction any longer. And every dollar that comes out is taxed as ordinary income. But the advisor loves it. And I went over this last week, so I'm not going to repeat. If you want a recording from last week to learn why your advisor loves your SEP more than you do, David, send me a message if you weren't here. Okay, so off the radar screen, we want most of it off the radar screen, and a couple of people said all. All right, as a business owner, how much do you want liquid? Which means how much of your wealth do you want to be able to access penalty-free, tax-free, without an application, without a repayment structure like a HELOC? David will hook you up, my friend. David, is this your first call? Oh, dude, we're gonna have fun. How much of your wealth would you want liquid? You know, there's a reason, as you're typing in this in, there's a reason I call my house equity debt equity. Why? Because I can't get to it. It's not my equity. I cannot get to it. If I go get a home equity line of credit, what does that mean? Line of credit. That means I have to go to a third-party lender, use the lender's money, prove that I have an income to pay it back, get the lender's money against my house as collateral, and the lender gives me their money. And if you want proof that that's not your equity, ask yourself, does the lender want to get repaid? You can't get equity out of your house. You have to borrow someone third-party money, or I sell the house. It's the only way to get out of the house is to sell it. And then, depending on what kind of residence it is, you know who else likes to get involved? They love to take the fun out of making a lot of money. Unless you do a 1031, which is a fun conversation. $1 million. David, I'm sorry, I don't know what I asked for when you what you're asking or why you said that, but I got a bunch of money in equity in my house right now. We're selling and we're restructuring a lot of this because debt has changed substantially recently. So, okay, so this is what we're going to talk about today, guys. We're going to talk about how I can get my wealth off the radar screen of the IRS and still keep it in a place that's liquid, where I don't have any penalties to access the cash. And if you care about your family, you're probably going to like this conversation. I'm going to go over a simple concept here right away. And I'm going to do this fast because we're 13 minutes in, and some of you have heard this, some of you have not. If you have a question, I talk fast, write it in the comments. You know, make sure I don't go too fast and forget it or leave you in the dust. I'm going to do a zero line. This represents no money. Okay. When I got out of college, guess what I did? Boop, went into debt. Wanted to buy that new car. I bought the new car. I paid an interest rate to the bank. Every month I had to repay it. So as I'm paying this off, what am I doing? I'm hoping at the same time I can start to save some money somewhere. And at the time I was doing a 401k. I was 23 years old, like an idiot, smallest tax bracket of my life, putting money into a retirement account, postponing a tax bill for 40 years in an account I could never use. And I'm in debt paying for a car. Okay. So what happened though? A few years later, car's old. You know, I need a cooler car. Why don't I trade it in, take another car loan? And what happens is you repeat this over and over. And it really hinders our ability to what we can build in wealth because I'm paying an interest rate to somebody else. This is why Dave Ramsey's famous. Okay. Debt is bad. I want to make a note. Not all debt is created equal. And I could go on that for days. So what Dave would talk about, you know, the entertainers say, well, instead of buying a car in debt, save money. And here's why Dave's famous. If you save an extra $2,000 every year, you'll have $2,000 extra by the end of the year. It's not a crazy claim. He's teaching you how to be responsible. He's right. But then he says what? To use what to go buy the car? Cash. So this person delays the purchase, and what happens to their bank account? Goes right back to zero. Maybe they save a bunch of money and they spend it and it doesn't go to zero. Maybe they keep, you know, 10 grand in the bank account. Okay. Hopefully they're not going to zero. The problem, in every single bank in your neighborhood, I don't care, you know, Virginia, Texas, Indiana, wherever you are, Michigan, every bank in your area understands this, the price of opportunity cost. Because when you use cash, what happens to the account value? It goes down. So the cost of the purchase is not necessarily what you took out. It's what you could have earned if you kept the money in. This is called opportunity cost, and you better believe that you can calculate how much you're losing. And the reason that this hasn't been a very huge topic lately is because what are banks typically paying? 0.02%. So the lost opportunity cost on a bank savings account isn't that high. It's not that big of a deal. Now you can get a high yield, which who knows how long it's going to be around, but at least I can get a high yield account. Well, if my savings account's earning 3%, and now I use cash to go buy a car, I just lost what that 3% could have earned me for the rest of my life. That's expensive. Texting my wife. That's expensive. That is true cost, because that's money that you'll never have. So the challenge is that we're losing money we don't even realize we're losing. It's the ghost of a ghost. If you listen to Ben Shapiro, it's the ghost of a ghost that you're chasing. So here's what we can do. What if you had an account that was guaranteed to compound, guaranteed to grow, at a rate that is going to rival a high yield savings account today? See, the difference that a high yield savings account will give you, that 3% is taxable. We already talked guarantee. We want tax-free growth. Guaranteed to grow, tax-free, off the radar screen of creditors. So liability and liquid. So here's how this works. I have money in this account, and I want to go make the car purchase. I have an opportunity. I can say, look, I have money in this account, so what I'm going to do is I'm going to take money out of the account. I'm going to take from my account. The account value is going to drop. I want to make the purchase. And what I've done is essentially reset my compounding curve. That is the value of opportunity cost. It's massive. The younger you are, the worse it actually gets. So I don't want to do that. I have the option. And if you want control over your finances, you need an option. And if you need proof, talk to anybody who's had a loan called in the past. The best way to get a loan is to prove you don't need one. You want a good interest rate on a loan? Prove you don't need the money. Post the collateral from something else. Control starts with what you do with your money, the first step of what you do with your money. So instead of taking from my account, I'm going to borrow against it. Not from it, against it. Donzella, a high yield savings account. If you ask your local bank, you can get a high yield savings account. By the time we're done with this, you probably won't want one, because what I'm explaining works better than a high yield savings account if you can qualify. But so let's talk about when I take against the account versus from. Now here's my example. Let's say I have a $500,000 home, and I take it's paid for. House is paid for. I take all the windows and the doors off of the house, and I sell them for $100,000. Yes, David, you're exactly right. But it's not the high yield savings account. So if I have a house worth $500,000 and I want to take out $100,000, I can sell all the windows and the doors, sell them for $100,000. Does that affect the value of the house? Yes or no in the comments. If I take the windows and the doors off the house, does that affect the value of the house? Sure does, because I took from the house. What's up, Jay? I took from the property. When I borrow against, I'm not taking from, I'm borrowing against an asset. And that word is so important in the financial industry. It's looked over often by the consumer. If I have a house paid for, I go to a lender and say, look, I want to post my house as collateral. I'm going to borrow against it. I get a loan from the lender. I need the repayment and all that. Does that affect the value of the home? No, because I borrowed against it. Now, theoretically, what's happening to the value of the house? We hope it's going up. So I want to borrow against an asset that's going to increase in value. By the way, David, remind me to talk about debt one time, because I want to short the American dollar using debt, and I want to buy appreciating assets using other people's money that I can leverage now debt or deflated dollars to pay off while my assets increasing in value. That's where the cash flow comes from. But before we even get that far, I want to show you how this simple banking principle needs to be switched up. Because I can call then the financial institution and say, look, I got the cash. I don't want to use my money. I want to borrow against it. And hopefully I'm going to go buy a cash flowing asset. And look, I get it. These were a lot easier to buy 3, 4, 5 years ago when interest rates were lower and housing prices weren't crazy. But even if the value of the home, if I take money and go buy a home and the value of the home is going up, I get massive tax benefits. Maybe it's not paying me as much, but it's an equity play. Now I'm gaining equity as inflation goes up, theoretically, housing prices will also go up. And I'm using deflated dollars to pay that off. So it's an equity play, maybe not so much as attractive upfront in the cash flow aspect, but it's an equity play. Trust me, it's still more fun to own than a 401k. So that's why I call a 401 cottage. My kids will enjoy my 401k, that is for sure. They are not going to enjoy my 401k statement. They do like the 401 cottage. So I borrow against this asset. And what happens to the value of the asset as I use other people's money, renters, to pay off that loan? What happened to the value of my account? David, I'm looking for your answer on this one. From there to there, it increases. The value of my account increased, and I was doing something else with my money. Why? Because I borrowed against the asset I didn't take from. So what product has guaranteed growth year over year, doesn't trigger an income tax, no 1099, provides this type of liquidity where I could post it as collateral to a bank? Oh, and liability, that says liability. That's off the radar screen of any creditors. Guys, there's 3 areas where the IRS will incentivize you to do business or to save on taxes. Number 1 is business. Everyone on the call should have an LLC on the side, do something that you can now take advantage of true business tax deductions, not tax deferrals inside of a SEP. Deductions are more valuable than deferrals, in my opinion. We're going to have a disclaimer on this anyway, so hopefully I can say what I want. As long as nobody's saying, Matt told me this, blah, blah, blah. These are all ideas. You need to talk to a financial professional with your unique circumstances before you make any decisions. Don't try and get me in trouble for helping people, please. It's all stuff's legal. You just got to do it the right way. So the first, business. They help. If you take care of, if you do business, they're going to help you. Why? Because it helps the economy. It employs people. It makes America better. Number 2, real estate. Here's my thesis on real estate. David, hopefully you get a kick out of this one. Donzel, hopefully you get a kick out of this one. It's my opinion that in 20 years, people are going to want to sleep inside. I think the value of real estate is going to continue to go up. In 20 years, I believe people are going to want to work indoors. I like my office. It's hot as hell. Somebody said it's 108 in Texas right now. Woo, thank goodness for air conditioning. If you didn't have air conditioning, maybe the real estate in Texas would go down because nobody wants to live down there. But we have air conditioning, so we've solved that problem. The government incentivizes that through depreciation, through tax deductions, through 1031 exchanges, through all of this. Why? Because we're providing a place for people to live, work, and enjoy life. We're making America better. Number 3, family. Say what you will about the current administration, this isn't a political call. But when the IRS started, I would like to believe that the government did hold up that family values. And since the beginning of the IRS started in 1913. Life insurance started in the 1800s. It has always been income tax free. It's not very political savvy to say, oh, you want to take care of your heirs? We're going to tax you on that. The death benefit is income tax free. There's an estate tax, which I could talk about at length at another time. Doesn't matter because you need to be worth over 20 million. That's a moving target, always moving. It went away the year that Rockefeller died. Go figure. That's weird. But the estate tax has changed. So life insurance, income tax free. Now I have an income tax free benefit that goes to my family. Let's say I have a house. Let's say I have a house that I'm going to pass on to my family, and they get a step up in basis, which means they don't have to pay tax on the gain of the growth of the value of the property. Well, if I have a death benefit that's going to the family tax free, guess what I get to borrow against? The death benefit. Tax-free. Tyler, you're asking a question I'm not following. Okay, I drew this wrong. Let me draw all this again. Here we go. Death benefit goes like that. So here's today. Here's age 90. Okay. I'm going to pay for life insurance till about age 65. Paying. Here, I'm not putting anything in. My death benefit goes up for the rest of my life. And I have created an account now that has what's called cash value. It's guaranteed to grow. It's guaranteed to grow. Doesn't provide or doesn't trigger a 1099, doesn't trigger any sort of tax. And I can use it as collateral. Not only can I just call the insurance company and say, hey, I have cash value, I want to borrow it. I can go call my bank and say, hey, I want to go buy a truck. I got 100 grand in cash value right now. The truck's $50,000. I want to use your money. I'll post my cash value as collateral. I don't want to use the insurance company's money. I want to generate a relationship with you, Mr. Banker, but I also don't want to pay you 8% like my neighbor, because I have a guaranteed loan. I have collateral. So let's post this as collateral. And because you have a guaranteed loan, I want to pay you 2% to go buy the truck. There's no risk in the banker for the banker. So you can then negotiate lower rates. I love it. Make sure if I'm going too fast, give me some feedback. Is this good? Is this what you're hoping for? So let me draw something out for you guys really quick. So here's what happened. Here's the first mistake that people make. Is they make income. They do a SEP IRA. It's violated everything we've talked about that we wanted. It's taxable at the exit. You can't control what it's in. You can't really access the capital. And then what's ever left over, they end up putting in a bank. And this becomes their savings account. And then what happens is they take from to go buy cars, college, or let's say you wanted to buy real estate. Let's say you put in $100,000, and then a mortgage company puts in $300,000. So you put in 25%. So you put in 100, and then you took on debt to carry the rest. Okay. This is a wonderful idea because you get deductions, you can get inflation helps you with this debt, and now you can start to depreciate the full value of the property more than what you put in. Jay knows what I'm talking about. So you get massive tax benefits. But let me ask this question. If it makes sense to use a mortgage for 75%, in other words, a mortgage is OPM, my favorite drug. If I'm going to use OPM for 75%, why wouldn't I use it for the 100, the full purchase price? Once I understand debt, inflation, depreciation, if I'm going to use a mortgage, why wouldn't I use somebody else's money for the down payment? When you have zero money invested in this property and it gives you $1 of return, this is called infinite rate of return, because you have no money invested. It's everybody else has got their money invested. And in fact, it reduces your risk if you do it correctly. God, I love this stuff. So here's what you do. Here's how you do that. So here's that first part, David. Controlling your wealth so that you can invest in cash flowing assets long before retirement. I replaced my bank with life insurance. And I fill the life insurance with this special rider. It's called a PUA rider, which just stuffs cash into the policy. My cash value will grow substantially better than a bank. I've immediately put in place a death benefit for my family. Immediately. Guess who doesn't feel guilty when I go invest in real estate now? Because if I die, what does my family get? The real estate and a tax-free death benefit to pay for the mortgage. And they can sell the real estate, or they keep it to create cash flow. Because at the end of the day, my wife doesn't want a big lump sum of money. She wants my income replaced if I'm gone. You guys know how real estate works in for legacy purposes? It's amazing. The step up in basis and the depreciation that you can get. You can depreciate the entire value of the property. Kids don't, you'll never have to recapture it because they going off on a side note. So I replaced my bank with life insurance. And then what happens is my family's taken care of. And when I want to go spend the $100,000, I call the insurance company and say, hey, I have $100,000 in cash value, but I'm not going to use my $100,000 in cash value. I want to borrow against it. Let's borrow against the 100,000. My available collateral has gone down. The insurance company does not recognize the reduced amount of cash value, and they're going to continue to pay me dividends and guaranteed growth as if all of the money was still in the account. I want to say that again. I take the money out and go buy a real estate property, hopefully cash flowing asset. The insurance company who I borrowed or leveraged, I leveraged my death benefit up to the amount of cash value, doesn't recognize my loan. And they're going to continue to give me growth on that asset, the cash value, as if all the money was still in there. Kind of like a home equity line of credit. The difference is real estate can go down in value. Life insurance is guaranteed never to go down. The only time you want to borrow against an asset is if it's guaranteed not to go down. That is a slippery slope. If you're going to borrow against a volatile asset, the underlying asset goes down in value. Now you owe the debt plus your asset's worth nothing. It's horrible. So borrowing against an asset that's guaranteed to go up is very important. Another thing that's great. When I put the money in this, I'm going to use the cash flow of that asset. Let me erase this stuff. What am I going to do with the cash flow? Right back into the policy. It's going to go back to fill up my collateral fund, my investment fund inside of the cash value. I get to take advantage of all these tax benefits that the IRS helps because I'm actually helping the economy, building housing for people. And the cash flow goes back to recharge my life insurance. I'm turbocharged. You know how turbocharger works? I'm turbocharging my cash flow, but because if I were to just use a bank in this, the bank wouldn't grow. It would just be taking money out, put it in, taking it out, put it in. This, I get to grow compounding forever. And by the way, if you care about your family, they get taken care of. It's so funny when I talk to conservatives who are like, Matt, look, dude, I'm conservative. I don't like doing anything risky. I go, okay, what are you invested in your SEP IRA or your 401k? They have no idea. But they know that they get a cool pie chart and says what projections are. Mind you, 2022, S&P went down 18%. No big deal. It'll come back up. What if you didn't have to worry about the volatility and you can go buy assets that you actually enjoyed owning? The problem isn't the financial industry. The problem is that people don't understand the choices. And the financial industry made it really easy for good-looking, smooth-talking ex-professionals to get into the industry and sell products like retirement accounts. You don't need a retirement account to retire. You need money. More importantly, you need cash flow. And how you generate that cash flow is probably more important than the account value or the rate of return you're chasing. Why? Let's go into part 2 that I said I would talk about. How do you generate tax-free revenue in retirement? Off the radar screen of the IRS. Guess what? My goal during lifetime is to do this supercharged, turbocharged method over and over again. Okay. And this could be a business. It doesn't have to be a real estate rental property. It could be a cottage in the woods, a cottage on the lake, a condo in Florida, multifamily. Like, I don't care what it is. It could be anything. This is why I love doing what I do, because I'm not going to tell you what to do. I'm going to show you how it works, and then you get to go do what you want and you're good at. Me, I want to have a house in the mountains, house in the lake, and a house in Florida. I'm going to take my family and friends to every one of them, and they're massive tax deductions all the way through. 401k is now a 401 cottage on the lake. Now my kids get to go visit that, and then they're, by the way, they're going to inherit that with no tax due. You ever seen the tax liability on a 401k or a SEP IRA to your heirs? Dude, when you're gone and your spouse inherits a SEP or a 401, they're now, the condolences from the IRS is that you're a single taxpayer. Sorry for your loss. We're going to change your tax bracket now. You're no longer married filing jointly. Single tax. Totally different tax brackets. Meaning much smaller income gets the higher marginal rates. If you can't tell, I love this topic and I'm kind of all over the place. If there's something you want me to hone in on here as I'm rambling to myself, make the comment. But so my goal is to buy as many cash flowing assets refunded by my life insurance and knowing that my death benefit is going to take care of my family. When we learn how to stop chasing a rate of return and enjoy our money, when you realize that money is a tool, and as an entrepreneur, most entrepreneurs understand that, man, I don't think I could ever save enough money inside of a retirement account to enjoy retirement. Ever. I have family members that, close friends that will never be able to save enough to duplicate their income, especially with inflation. If the cost of bread and the cost of meat is up 40% in the last 4 years, did your account value go up 40% in 4 years? Hope so. And if it did, that means it's even to where it was 4 years ago. And we were like, oh, the account's up 40%. I had someone post a stupid thing on Facebook. Since the new president got in, your account value went up 40%. What does it do to you? It does nothing, because the cost of living just went up equal to that at least. By the way, start taking money out of that account. As soon as you have a down year and you're taking money out, now you're really in trouble. So what am I going to do? I want these accounts to constantly replenish this cash value. Because when I get to age 65, I'm going to have a really big death benefit. I'm hopefully going to have a bunch of cash flowing assets and have a really big death benefit. I then can take, if this is fully funded, I can start taking distributions as loans, surrender, whatever. I borrow against that asset. Guys, no 1099. The government doesn't know the money exists. If you get sued, they don't know, depending on where you live in the country. You don't even have to claim it as an asset. Kids going to college, it won't hurt your ability to get a loan for your kid's student loan, because it's not looked at as an asset like other assets. It's insurance. It's a benefit to your heirs. How dare you touch that? It's for the family. The government likes you to take care of your family. So in retirement years, if I fully fund the retirement account, I have cash flow from that that I can use in retirement that doesn't generate a 1099. Here's the cool part. Let's say I have here's my SEP IRA. Here's my life insurance. Now I'm 65 and I want to live to age 90. I'm going to go through math here because we're already coming up on 45 minutes. So I'm going to kind of end with this really quick. I'm going to put a link in here. I don't know your individual situation. I do these for free because I want people to understand the options. If you want to go over your specific position and options that you might have available, that's my link for that is not the right link. Hold on, I just messed up. There we go. That is the link to get on my calendar for 15 minutes, absolutely free. We'll jam if it makes sense to work together, great. If not, hopefully I can point you in the right direction. Here's my final thought for you in the retirement ideas. If some people want to stop, I think a lot of people are going to be consultants, you know. It's not going to be retirement where you live on your assets solely. You'll probably have hopefully we have outside assets that pay us. But if I'm relying on a retirement account to generate income in retirement, I'm going to need $4 million to duplicate about what I'm going to say 1.7 million can do inside of life insurance cash value. I need a $4 million account value to duplicate what about 1.7 can do in life insurance if I want to live during this time frame in retirement. And the reason is you have taxation, you have asset management fees, they got to get paid, and you have market loss. And the reason, I'm going to end you with this. Give me your feedback, please. You at least owe me that. The reason that I need 4 million is because of all of these costs. And if you were a financial advisor, you would get a commission to pay a commission on your first premium. You know, you'd get a small commission on the first premium that the client starts, or I can charge a fee on the gross value pre-taxed, knowing that if the client were to take it out, you know, half is going to go to the government. No. I get to charge a fee on the full amount every single year. Are you curious why the financial industry loves qualified retirement accounts? Your CPA says, I'm going to save you taxes. You don't get tax savings, and you can watch last week's presentation. I proved it. It's tax postponement. And then the CPA says, by the way, I got a great financial advisor. He's going to gamble with your money. Take no risk, but he will charge you a fee every year for the rest of your life that you work with him on the gross value. And he's going to give you a statement with a number value on it that you'll never see, because when you take it out, they're going to say, how much do you want to withhold in taxation? But they get to charge, there's so many stories here. They get to charge you the full fee on the gross amount. So of course, the advisor makes a lot more money with managing pre-taxed accounts. If you want proof, why doesn't Netflix charge you a one-time fee or one-time commission to buy Netflix? Well, we're only going to up your fee here, $1.99 for the family, you know, but we have so many more movies to watch. $1.99 a month, every month for the rest of your life that you want to use Netflix. Show me the client's yacht. That's right, bro. That's a quote in my book. It's the beginning of chapter or phase 3 is clients buy stocks, advisors buy yachts. Hopefully I didn't break my pencil. Eye-opening. We will be talking again. David, it's great to have you here, my friend. I hope so. Anybody doing a SEP means you're a business owner of some sort. So you're a free thinker. You'd also dig the book. Where is it? Right there. But hopefully everybody else loved it. Tyler, Jay, good to have you guys on here. Can I up? Yeah, dude, taxes are going to go up. I love it. If you want to join us next week, we will continue these conversations. I have so many things in here that I could talk about. So, you know, let me know if there's something you want me to go even deeper on. You know, what I like to do is the life insurance stuff too. Once people understand that how the value of the life insurance tool, I can give real examples showing illustrations, money going in, money going out, death benefits, loan amounts, commissions, all of it. So, David, same time next week, and don't worry, the automation bots will remind you. I was hoping you'd click that link for a 15-minute phone call. Lori, great seeing you. Thank you for being here. Dave, smash that 15-minute phone call. Let's chat this week. And yeah, at the same time, it's 4 o'clock every Wednesday.